£3.34 billion. That's the tax bill HMRC is set to collect from pensioners' savings interest this year alone. And if you're over 65, there's a good chance some of it is coming out of your pocket without you even realizing it's happening. Because right now, more than 2 million people aged 65 and over are about to get pulled into paying tax on money they thought was simply sitting safely in the bank. And stay until I get to the fourth thing on this list, because that's the one about the ISA rules changing from 2027. And it's the one detail almost nobody your age has actually been told about yet. I'm Joan Whitfield, and I spent years working in retirement financial planning here in the UK, helping older clients make sense of exactly this kind of quiet tax creep. And that's really the heart of the problem. HMRC doesn't ring you up and tell you when you owe them money on your savings. It doesn't send a friendly warning before the tax year starts. The system runs entirely on you knowing the rules yourself. And if you don't, it just adjusts your tax code and takes what it's owed, often without you understanding why your pension income suddenly looks smaller. There are several moving parts to this story, and most people over 65 only know one of them, if that. So let's go through them properly, one at a time, because by the end of this, you'll know exactly where you stand. And remember, stick around for the fourth point about the ISA changes. The first thing you need to understand is just how fast this has grown. Back in 2022 to 2023, around 517,000 people aged 65 and over had an income tax liability on their savings interest. This year, that number is forecast to be around 2.1 million. That's more than 4 times as many older savers being pulled into paying tax on their interest in just 4 years. And it isn't because pensioners suddenly got reckless with their money. It's because interest rates rose, savings accounts started actually paying something worthwhile again, and the tax-free allowances around that interest simply haven't kept pace. If you've got a decent chunk in an easy access savings account or a fixed bond, and you haven't checked the rules recently, you could already be one of these 2.1 million people without knowing it. Here's who this actually affects. It isn't just wealthy retirees with huge portfolios. It's ordinary savers, people with a modest pension and a rainy day fund sitting in a normal bank account. People who spent decades being told that saving responsibly was the smart, safe thing to do. Basic rate taxpayers get a personal savings allowance of up to £1,000 of savings interest a year before any tax is due. If you're a higher rate taxpayer, that allowance drops to just £500. And if you're an additional rate taxpayer, you get no personal savings allowance at all. So the exact amount of interest that triggers a tax bill depends entirely on what income band you're already in, which means 2 people with identical savings pots could have very different tax outcomes. But what happens if your income is lower, if you're not really a higher earner at all? That's next, and it matters a lot. There's a second allowance that a huge number of over 65s have never even heard of, called the starting rate for savings. This one can give you up to an extra £5,000 of tax-free interest on top of your personal savings allowance. But here's the catch, and it's a real one. That £5,000 shrinks by £1 for every £1 of other income you have above your personal allowance. Once your other income reaches £17,570 or more, this starting rate disappears completely. So if you're living mainly off a modest state pension and a small private pension, you might actually be entitled to keep thousands more of your savings interest tax-free than you assumed, and simply never claimed it because nobody explained it to you. This is the exact kind of rule that quietly costs ordinary people real money every single year, purely because they didn't know to check it. Now here's a twist almost nobody thinks about until it's too late. People with more than £10,000 of income, specifically from savings and investments, are required to register for self-assessment with HMRC. That's not automatic. That's on you to do. If you've had a good year with interest rates and your savings income tips over that threshold and you haven't registered, you could be looking at penalties on top of the tax itself. This next point affected people who never imagined they'd have to fill in a tax return in their retirement. And a surprising number still don't realize the rule applies to them. Let me bring this to life with someone you might recognize a bit of yourself in. Picture Brian, 68 years old, retired school teacher, sensible with money his whole life. He's got about 40,000 pounds spread across a couple of easy access savings accounts and a fixed rate bond, money he's kept aside for emergencies and for his grandchildren one day. For years, that money quietly earned interest under the radar, but interest rates went up, his bonds started paying properly for the first time in over a decade, and suddenly his savings interest crossed his personal savings allowance without him doing anything differently at all. Brian didn't get a phone call. He got a tax code adjustment months later that left him confused about why his pension payments had shrunk. Brian isn't unusual. Brian is now one of over 2 million people in exactly this position. And here's a second, smaller thing worth knowing right after that, because it can genuinely soften the blow. Interest earned inside an individual savings account, an ISA, doesn't count towards your personal savings allowance at all. It sits completely outside this whole tax calculation. So if you've got savings sitting in an ordinary account earning taxable interest, and you haven't fully used your ISA allowance for the year, that's real tax-free shelter you might be leaving on the table right now, this tax year, not some point in the future. This is the one I told you to wait for, because it's about to change in a way that specifically favors people your age. Right now, everyone gets a 20,000 pounds overall ISA allowance each year, and that includes the cash ISA portion. But from the 6th of April 2027, new rules come into force, and the cash ISA limit for people under 65 is going to fall to 12,000 pounds. Here's the part that matters for you specifically. If you're 65 or over, you keep the full 20,000 pounds cash ISA allowance. And the higher allowance kicks in from the start of the tax year in which you actually turn 65, not from your exact birthday. So if you're approaching that age, there's a real meaningful advantage waiting for you that younger savers simply won't get. And it's worth planning your savings around now rather than after the rule changes land. So here's where all of this leaves you. Andrew Wright, head of savings at Paragon Bank, put it plainly, saying that millions of older savers are being pulled into the tax net, putting more of their retirement savings at risk, with 4 times as many people aged 65 and over now facing a tax bill on their interest, compared with just 4 years ago. His advice is simple and worth repeating. Review where your money is actually held and use your ISA allowance properly. Because from next tax year, savers 65 and over keep the full advantage while others lose part of theirs. To recap quickly, more than 2 million over 65s are now liable for tax on savings interest, a 4-fold jump in just 4 years. Your personal savings allowance depends on your tax band, either 1,000 pounds, 500 pounds, or nothing at all. There's a separate starting rate for savings worth up to 5,000 pounds that disappears once other income passes, 17,570 pounds. Anyone earning over 10,000 pounds in savings and investment income must register for self-assessment themselves. And from April 2027, over 65s keep the full 20,000 pounds cash ISA allowance, while younger savers get capped at 12,000 pounds. If you've got a parent, an aunt, an older neighbor, anyone over 65 who's ever said, "I just keep my savings in the bank," send them this today. It could be money that's already quietly being taken from them without them understanding why. Subscribe now so the next time a rule like this changes, you hear about it before the deadline passes, not months later in a confusing letter from HMRC. Because the truth is, nobody in this system is going to chase you down to save you money. But with the right information, you can absolutely save it yourself. I'm Joan Whitfield, and I'll see you in the next one.